Within the COMESA, for example, a lot of trade does take place. And if you look at the exports, COMESA is one of the largest economic grouping in that particular area. And you can see the exports that come out of that area to other countries are led by Egypt, of course, followed by Libya and Sudan. If you look at the individual components of what constitutes those exports, a lot of that is oil that is actually in these countries. Kenya does quite a bit of trade within the East African community, and of course, parts of Europe and US. If you look at the imports that come into the COMESA, again, Libya and Egypt tend to have the highest level of imports. Of course, when they export the oil, the exchange is to be able to bring in goods that can be able to sustain their people in terms of food, clothing, and other related stuff. If you look at intra-trade, just within amongst the members themselves, then again you can see that the country that trades most with the other COMESA members is Egypt, Libya, Sudan, Zambia, and most of these are actually in mineral forms. The other thing that you will notice is that most of the African countries are actually factor-driven, in the sense that a lot of their business is derived from what they can be able to get naturally, either it's minerals or it's forestry, timber, and things like that. Except for a country like Kenya, which is not very well endowed in natural resources, Kenya has developed what we call a knowledge economy, and most of what we export is actually the human resource. Again, intra exports within the COMESA, you're looking at Egypt, you're looking at Kenya, and you're looking at Zambia. Now, you'll be surprised, for example, that Egypt, which is really, most of it is desert, controls the waters from the Lake Victoria. Lake Victoria is located within the three East African countries, that is Kenya, Uganda, and Tanzania. But some funny treaty was signed sometime in early 90s, which states that none of the countries that surround the Lake Victoria can do any substantial project without consulting Egypt. And therefore, actually, there have been a lot of issues where countries have now begun to say that it is not fair for Egypt to control a resource that is not within their boundaries. That has had an impact, for example, that Uganda cannot produce sufficient hydroelectric power from the Nile, the River Nile, because any development that is intended to interfere with the flow of water is deemed to be a violation of the act that was signed sometime in 1912. And Egypt will use the water to grow oranges and export those oranges back to Kenya and Uganda. If you walk into the supermarkets, you'll see that those products are packaged actually from Egypt. And those are some of the things that actually are being worked on to be able to say, why can't we be able to correct this kind of anomalies? Now, I know that there have been issues about the risks of doing business on the African continent. Politics is an issue. The way we practice our politics leaves a lot to be desired. We talk about democracy, but it is democracy on paper, democracy on the ground are totally two different things. We talk about capitalism, but we practice capitalism without capital itself. And it brings us quite a bit of challenge when we look at these issues. Now, realizing that Africa needed a lot of foreign direct investments, about 12 countries got together under the support of the World Bank and set up the African Trade Insurance Agency. This is a credit insurance that is funded by member countries. The membership initially was 12 countries. That has grown to cover about 20 countries, all of them on the African continent. Initially, the ATI was set up to provide political insurance for any investment that is undertaken on the African continent. But ATI, from 2001 when it was set up, to date has evolved and developed other products like credit insurance, first on export receivables, and now they've come down to domestic receivables, which means that any investment, if you're looking at undertaking a major investment in any of the countries that you're interested in, ATI will be able to give you cover, either for political risk or for credit risk or whatever it is. ATI is also now working with banks to see how banks can be able to mitigate against the credit risk, to allow banks to move out of the collateralized lending that has defined their business for a very long time. If you look at the political insurance, where does it actually go? In which sectors has it been going? You look, most of it is going to the construction, energy, ICT, infrastructure, manufacturing, mining, services, and tourism. And those are actually the sectors that, if you looked in terms of contribution to GDP, those are the sectors that have the highest contribution to GDP in most of the African countries. If you look at country performance, which country has received most of the cover, whether it's political, credit insurance, that country is actually Kenya. And of course, DRC, a bit of it has gone to Zambia. But Kenya does enjoy quite a substantial bit because most of the organizations or most of the companies that want to do business on the African continent, particularly if it is in the eastern part, if they're not going to South Africa, most of them will set up a base in Kenya. On a sector performance, you can see that a lot of the insurance has gone into agribusiness, agricultural related businesses, infrastructure, manufacturing, services, construction, tourism, ICT, mining, and energy. Again, it's just a relook at it from a different perspective. Now, if we look at what has been happening on the credit front in terms of credit practices, what you find is that most of the businesses, that the indigenous businesses, are still very small companies. Other than the multinational corporations that have extensive operations on the continent, individual countries have much smaller businesses. You'll find that only South Africa, Kenya, Nigeria, and Egypt have been able to grow companies that now can go to other countries to do cross-border business. Most of the other countries still have very small companies that do not have the capacity to cross borders and do business in other countries. Banking and insurance penetration is still very low. Insurance is actually less than 2%, if you ask me. Banking is still, the business model for banking that was set up in the colonial times is still what has been driving banking services in those countries. Now, that model was a model that was based on high margin, low volume. So you find that banks are concentrated on very small market segments and deny the rest of the population access to banking services. Most of the credit that is extended is actually on a secured basis. Attempts have been made to try and bring small businesses and consumers into the lending, but when you look at consumers who come in, you're actually looking at salaried people, and for small businesses, it is still a very big challenge. In the absence of infrastructural institutions like credit bureaus and rating agencies, which are still very young and do not operate in most of the countries, information sharing is desired, but because of the information asymmetry between the borrower and lender, what banks have done is to stick to the collateral lending model, where for every credit they give, it has to be secured with some collateral.